For those of you who have already finished trading comps valuations, we had 3 issues when doing trading comps valuations. To give you a slight recap, our number one focus, key issue was which multiple are we going to use? Are we going to use, price to earnings? Are we going to use EV to EBITDA? Are we going to use price to book value? There were like a million types of multiples, and we had to decide what to use. That was our number one issue when doing trading comps valuations. Number two, we had to figure out who are the real peers, or who are the real similar transactions when we're doing comparables valuations. We had to choose from a billion companies around the world and select only 3 to maybe 20 peers in order to do a trading comps valuation. So that was our number 2 issue. Number 3, from which time frame are we going to do our valuations? So when we're using price to earnings, from which timing, what timings earnings are we going to use? Are we going to use last year's earnings? Are we going to use last 12 months earnings? Are we going to use future estimated earnings? That kind of decision had to be made in order to do a trading comps valuations. But for DCF valuations, we have 4 major factors, or in other words, 4 issues that we have to figure out when we're doing a DCF. Number 1, how are we going to forecast free cash flow? So this is one of the most important, obviously, when we're doing DCF. However, we've done most of it. We've already forecasted the components of free cash flow, so we've done most of it. Maybe we have to extend our forecast years in our actual Excel session, but anyways, we have put in so much effort in how to forecast free cash flow, and this is one of the most difficult parts of DCF valuations. It has a positive impact on enterprise value. Obviously, the more cash flow you predict, the higher the enterprise value would become, and the level of impact, of course, and obviously has a very high impact on the enterprise value. Number 2 issue is terminal growth rate, or the exit multiple, if we use the exit multiple method. This again has positive values. The more terminal growth rates you assume, the higher the enterprise value would become. And the level of impact is still it's a very important assumption, but personally I think not as much as free cash flow. But anyways, it's another important decision to make when we're doing DCF. Number 3, how much years are we going to forecast? So we have, we had 2 areas. We had part 1 and part 2 areas of doing a evaluation. But depending on how long you forecast your DCF, depending on if you're doing a 5-year DCF, if you're doing a 10-year DCF, 20-year, 30-year DCF. Depending on the forecast years, usually the longer you project, the higher your enterprise value becomes. So it's also a very important decision to make. Of course, there are certain rules or situations when you can extend your forecast years. We're going to be talking about that in a few moments. Number 4, the most important, weighted average cost of capital. So the discount rate. Which number are we going to use as our discount rate would be the biggest issue that we have to figure out. Of course, we're going to be talking about this as well in a few moments, in a very detailed manner. But anyways, the key is that because it's a discount rate, the higher the weighted average cost of capital, the lower the enterprise value. So this is the only component that has a opposite direction. The higher the cost of capital, the lower the enterprise value, because simply you're doing much more discounts. So these four factors are the four major factors that we have to figure out in order to do our DCF valuations. And let's go over one by one and discuss it in more details.